Joining us right now to talk markets ahead of today's jobless claims and the retail sales data is Matt Powers. He's with Powers Advisory Group. He's the managing partner there. Matt, we were just talking in the last block about why the market keeps going higher. Why do you think that is?
Well, good morning. First of all, thanks for having me on. It's earnings season. We're deep into it, and the election is a few weeks away. And what we're seeing is volatility normally peaks before a presidential election and subsides afterwards, regardless of the results. What we're telling our clients, focus more on earnings and less on the presidential election. I know you guys were just talking about it in the battle for Congress, but what we see, the S&P is priced at 21 times projected earnings for next year, with the Mag 7 PE is 28. In comparison, the equal weighted S&P is at 17 times next year's earnings. So it makes it clear, based on valuation, that investors need to explore some long-term opportunities outside of the megacap tech. Own them, hold them, look for alternatives. But it's standard practice for anyone with a portfolio to diversify, and this is a pretty good time for that.
So what do you see that you like outside of the mega caps?
Earnings drive share prices, and we're in earnings season again. And, there's not a lot to report on the economic side right now. So all eyes are on earnings. And main takeaway is that there's pressure to deliver results, and the bar's high when the outlook's stable. It's nice we moved away from some of the interest rate discussions, and things appear to be good right now. But two sectors that we like financials, we like utilities, and I think they just yesterday touched all-time highs again in both sectors. But all 6 major banks exceeded or came close to exceeding expectations, and it just kind of shows us the banking system's well capitalized. They have balances somewhere roughly around $3 trillion, and they're ready to support economic expansion. And when you've got the 6 largest financial institutions telling us they're in good shape, and the economy appears to be in good shape, I mean, the market's response has been positive.
Yeah, we've even seen that spread out to the Russell 2000. It's at its highest level since November of 2021. Within financials, I know you said you were kind of watching Morgan Stanley recently. What did you think of the earnings yesterday? The street seemed to certainly like it.
Yeah, and even going backwards, it's a lot of people say that it's rates driving, but it's not just rates. It's capital markets activity. It's the wealth management is increased, and asset management benefits from this rotation out of fixed into equities. And so you have these financials with strong earnings growth, great balance sheets, and high dividends. But Morgan Stanley, when you think about a good company, you think about a company that's well diversified. All 3 of those areas that I just talked about. So you think about wealth management, investment banking, and asset management, and they've been on our radar for a while. And I know you just had the earnings announcement yesterday on your show, and Ted Pick was interviewed on the network as well. But we thought it'd be a good time to maybe bring them back up and circle back to them. But they knocked it out of the park, and they validated the reason that we liked them in the first place. So the investment banking revenue increased 56% year over year. New asset growth in the wealth unit is up, and reduction in rates again, and this rotation to equities it's certainly helped their asset management side. So at the end of the day, we have a dividend growth lean, and that kind of leads us into the companies. And they've got a yield roughly of 3.3%, but explosive growth over 10 years, over a 30% dividend growth rate over the past 10 years.
Okay, let's talk utilities. What's the name you like there?
Nextera. We've liked them for a while, and I've kind of wanted to talk about them a little bit. And so they've got industry tailwinds. They're the leading sector year to date. Investors look for reliable income alternatives when you got this rate cutting cycle. And it's the story has been the growth from powering AI data centers, which it's been talked about for most of the year. But they're the world's largest generator of wind and sun energy, and these AI data center the power will rely heavily on renewable energy. So they're in a good position. It's kind of interesting. Post hurricane, that's I think 3 million people lost power, and 1/3 of that were. So Nextera is the parent company of Florida Power and Light, which is the largest regulated utility in Florida. And 1/3 of those customers were FP&L, and it appears they've got them all back up and running. So I'm curious to know. They announce earnings next Wednesday, so I'm curious to know how that plays out. But regardless, going back to the dividend side of things, they growth rate over 10%. They've got a 63% payout ratio, which is pretty good for the utility sector. So that'd be our pick in that area.